Hi, good morning, everyone. And thank you for joining me today in this session where we will be talking about how to choose the right option strategy for your trading signals. So let me give you a background about what we are going to cover in today's webinar. So if you think of it, why people want to get into options trading, or let's say what should be the motivation, what should be the right motivation of getting into options trading. Historically, as you all know, that people used to buy stocks in their portfolio, or they used to trade futures, and that was a very lucrative thing to do. But eventually, what we have seen more recently in the last few years is that the option volume has kicked up very, very big. And one of the reasons for that happening is that in general, if you look at the CAGR return that used to be there earlier, and what is the kind of CAGR return that we have now, there's a wide difference because the CAGR return earlier was so huge. If you talk about, all the way up to 2008 and post that, then there was a significant amount of CAGR return that people could go and make by even buying stocks. But later on, it dropped down to almost 7-8%, and that is not good enough for people who are looking at investing in the stock market. So then later on, traders resorted to, first of all, futures where they can leverage the return, maybe 3x, 4x. But that is also not good enough because you'll have to bring in a lot of margin. So finally, this is where it is, and this is where it should be, that most of the volumes are now in options, which can give you a natural leveraging. So that's one side of the game. But if you look at the other side of the game, then options does not just give you leveraging, but it also provides you a better mechanism of amplifying your returns and even optimizing on the risk that you are taking. And I was talking about the motivation. So the motivation that one should have of coming in the stock market and trading options should be to amplify your reward to risk. So let me explain you what that exactly means. If you are trading, let's say, obviously you have a choice that you can go and trade the cash or the underlying stock directly, or you can go and trade futures. But why would you not want to do that and get into options? There should be some benefit of doing it. So the biggest, or the most important benefit that I see of what motivated me to come and trade options was that if I, let's say, trade futures and I have a 100 rupee target on, let's say, Nifty, the most, or Bank Nifty, these are the most favorite indices that people look to trade in India. So let's say Nifty, if I have a target of 100 points and I say that maybe in a couple of days, the Nifty can go up 100 points, and I have a stop loss of 100 points. Okay, let's say that's my view, that my stop loss is very far away. It's almost 100 points, and the target is also 100 points. So what is the reward twist that I have? The reward twist that I have is 50 equal, right? It is 50-50. So it is basically one. One is the reward twist, which is not good enough. So when you are trading futures, what happens is that you will have to have a very strong forecasting. Unless and until you have a very strong forecasting and you have a fantastic strike rate and a fantastic, forecasting power, till you don't have it, it's very difficult to go and make money when you are trading futures, because it's all about forecasting when you are trading futures. But that is not the case with options, right? So when you are trading futures, if the market goes up 100 points, you get 100 rupees profit. If it goes down 100 points, you lose 100 rupees, and that's how it works. You cannot go and optimize anything. So the entire game is that you will have to have a very good forecasting. And let me tell you my experience, historically, hundreds of people have worked in my team in research as well, where most of them come from, at least 10, 15 years of experience. And what I have seen overall is that 64-65% would have been the best strike rate of the maximum strike rate of the best analyst that I might have had in my team, right? So if people tell you that they have a strike rate of 90%, 100%, so it's very unrealistic. I don't think that if you're paper trading, that is possible, right? But when you're actually going and trading in the market, you will have all possible things that can go wrong where, your first of all, your emotions will start playing. The moment you go and take a trade, you'll not be able to think rationally. And that's what creates a lot of problem where people tend to book small profit and, stay or be in large losses. Then you'll also have slippages, you'll have brokerages that you'll have to pay, you'll have taxes that you'll have to pay. There's so many things attached to it. You might have some operational risk, right, where you entered some trade and there's a mispunching going on. And then you'll have impact cost. That was one of the major, issue that we used to face when, let's say, as a money manager, if you're managing too many clients, then impact cost also makes a lot of difference. So combined everything, a realistic strike rate, I have not seen, more than 65%. I'm talking on an average, and some extreme might be up to 72%, but you cannot have 72 is very unrealistic because there'll be some exceptions you will be able to achieve it. But on an average, 64% is what the strike rate will be. And with that strike rate, even if you go and trade futures, then will you be able to optimize on your reward to risk? So the answer is no. So what happens is that instead of trying to forecast the market and trying to be, God, where I can forecast every move that is going to happen in the market, which is more of an amateur trader behavior that they would want to go and track all movements that will happen in the market. But if you see more matured people, so with matured, I mean that, people who are doing prop book for 10 number of years, or I have so many friends in Chicago that I've met who do some strategy and they've been doing it for the last 20, 25 years. So if you get into a more sophisticated way of trading options, then I think it is more about the mathematics rather than getting into forecasting, right? So I'm not saying that you don't need forecasting. You will need some element of forecasting for sure, but the majority of the profit will not come because of forecasting, and that might be sounding new to many of you, but that's the reality that forecasting plays a very small role in the overall game. So what is the bigger portion of it? So the bigger portion is that when you go and trade options, using option mathematics, can you go and amplify the reward to risk in the same forecast? So let's say if I have a forecast, or let's say I don't have any forecast, right? And I just flip the coin every day, and I say, okay, head means that the market is going to go up, or tail means that the market is going to go down. Can I go and make money on that? So the answer is yes. If you can go and make money on that as well, because forecasting will not play a very important role. And how would you be able to achieve something like that is that when you go and trade options, then what I can do is I can choose a right strategy. So let's say if I'm forecasting 100-point Nifty will go up, I can choose a strategy to optimize on that. If it goes up by 100 points, I make, let's say, 1,000 rupees in the option trade, okay, on a per lot basis. And then if the market goes down by 100 points, which was my initial stop loss, right, then I will use only 500 rupees, right? And using options, because it's a non-linear instrument, futures is completely linear, it's a straight line. But using options, you can achieve something like that, and it could be anything. It will depend what the market is trying or willing to give you. It might be 2:1, 3:1, 1.5:1. So that the market will tell you, which we'll see in some time. But that's the real game, that every time you have a forecast, that forecast might not be, 70%, 80%. You don't need that. Even if you have a 50, 55, 58% strike rate, even that is good enough. All you have to do is that you will have to optimize on which strategy you go and initiate, which we'll see in action in some time, that we can choose the right strategy. So if the market goes up by 100 points, you make 1,000 rupees. If the market goes down by 100 points, then you lose only 500. By doing this, what happened is that I've created a reward risk of 2:1 for myself. And if I keep doing that consistently without focusing too much on forecasting, still I'll be profitable, because every time I'm making money, I'm making more money. And when I'm losing less money. And this is honestly the most important, segment of where your profits will come from when you are trading options, that you need to choose the right mathematics. So The forecasting going wrong is something which is not in your control. You cannot be God and you cannot forecast all moves that will happen in the stock market, which many people tend to do. But the option mathematics being right is something which is completely in your control, which you know in advance that, okay, if this is the forecast, then I need to create the strategy. I'm not saying that the market will behave in the same way, but most probably every time you'll be able to at least take the best possible decision. And that's what it is all about. But having said that, let me show you, if you do something like this in reality, obviously it is not going to be so easy, right? So let me show you what are the possibilities of combinations that you can have. So let's say if I talk about Nifty, so roughly there are about 65, there might be some more or less, but approximately there are about 65 strikes that you have when we talk about Nifty, right? And you have calls and then you have puts. So basically there are two more possible ways of trading it. And then you can buy and you can sell things, right? So there are another two ways of how you can go and do it. So if you think of it logically, the number of possibilities of how you can go and take a trade is 65 multiplied by 2 multiplied by 2. Oops, sorry. Multiplied by 2. So this multiplied by this, right? So there are 260 ways of trading the option chain, right? So if you just go to the option chain, let me just show it to you. If I just go to option chain and look at the Nifty, there are 65 strikes, there are calls and put, you can buy and sell them, right? So overall, there are 260 ways. I'm saying just approximately, some instruments might have more strikes, less strikes, right? So 260 ways of how you can go and create an option strategy. So let's say, I'm sure you might have heard about obviously single leg strategies like long call, long put, short call, short put, and things like that. And then there are two leg strategies, which are bull call spreads, vertical spreads mostly. There could be three leg strategies like butterflies. Then there could be four leg strategies. So butterflies are, the reason I'm calling it three legs because the middle strike is same. Okay. And then there are four leg strategies like condors and things like that. So if I have to, obviously from this mathematics, if I'm saying, if you recall your school times, when you were asked to solve a math question, obviously the math question is objective in nature, which means that it cannot be subjective, that for somebody it can be different and for somebody else it can be different. It has to be the same, right? So if you have a forecast and on that forecast, out of the entire option chain, if I say that, I can go up to four leg strategies, then there will only be one answer which is going to be the best answer. And this entire effort and journey that we are trying to, all this effort that we are trying to put inside this is to find that one best answer. But what is the basket that we are trying to search it from? So if you just see how many are the combinations of how many strategies we can go and create. So let's say if I want to create a four leg strategy, then if I just do a symbol combination, right? 260 ways of trading it and four leg strategy. If I go and create that, then it will be 186 million combinations that you can achieve from this, one single option chain, right? And if I say a three leg strategy, and if I do combination of that, then there are about how much? This is 28,95,620 ways of doing it. If I say two leg strategy, then there'll be 33,670 ways of doing it, and one leg will obviously be just this, right? So if I sum it all, and if I just divide it by a million, okay, so there are roughly 189 million ways of how you can do an option strategy, right? So that's huge, and that's why option as an instrument is not that straightforward. It's slightly complicated because it's not a linear instrument that you can go and just trade it like futures or as the spot market behaves. But options is going to be, more complicated, at least compared to that. But there are, if you look at the benefits, there is obviously benefit of investing your time and skill and generating those skills of getting into options. So if you see this, then there are about 189 million ways of how you can go and create an option strategy on one simple forecast. So if I say one forecast and we can go up to 4 legs, right? Then there are 189 million ways of how I can create an option strategy. But if we believe the mathematics, then obviously the best answer is one of this entire 189 million combinations, right? And the task, and where the profit can come to you is if you can find that one answer from this 189 million combinations. And obviously, you cannot do it by hand or by just trying to create a gut feel. You cannot achieve it. You will need machines to go and do it, because for a human being to go and evaluate all the possibilities, if you try and solve this, it will take you a number of years to go and do it. So using machines, obviously, you can speed this up and you can go and calculate all 189 million combinations and find the best possible answer from it, and it can tell you, okay, this is the best answer, and you can go with it, right? So just on summarizing on what we are trying to achieve, let's understand the problem area first. So I said that if we want to trade Nifty futures, let's say, and my target is 100 point and my stop loss is also 100 point, then what is the reward to risk I have? The reward to risk I have is 1. Okay. The motivation of getting into options should be what? The motivation should be, so this is the future trade. Let me write futures over there. So if I'm trying to trade options, what I would want to achieve is that it should be better than futures, right? Not always it can be better than futures, but most probably you'll find an answer. In most of the cases, it should be better than futures. So what I'm trying to find is that can I find an option strategy which can give me, let's say, 200 instead of 100? And when I lose money, I just lose 100. If I am able to find something like this, then my reward to risk shoots up to 2:1. And that's what makes the entire game profitable, because even if your forecasting is not good, and even if it is good, it is not going to be beyond 60-65% adjusted for all the cost and everything that you are going to incur. So you will need, the inherent characteristic of options to go and help you in making money, right? So I hope that what we are trying to achieve should be very, very clear, and this should be the primary motivation of getting into options. But then finding this one strategy is going to be a slightly tedious task, because you'll have to find that from this 189 million combinations. And let me tell you, even after that, it's not so easy, because if I just give you an example, let's say there's strategy 1, which has a strike, which has a profit, or let me write it like this, profit of 100 rupees and stop loss of 50 rupees. Okay, and there is strategy 2, which has a profit of 1000 rupees and a loss of 500 rupees, or maybe let me call it 40 rupees, okay, or maybe 25. So if I go and look at the reward to risk, then the reward to risk of the first strategy is 4:1, and the second strategy is 2:1. So which strategy do you think we should go and choose? If I'm paying, so ideally, obviously it's a monologue, so you can't directly reply to me, but you can write in the chat box at least. So if you think of it, then I will go with strategy 2, right? So that's why I'm saying that it is slightly tricky in nature of how you go and choose the strategy. Because let's say if I'm paying a 1 lakh rupees margin for this, okay, for both the strategies, then obviously I'm not interested in making 100 rupees. Okay, on 1 lakh rupees margin, if I make only 100 rupees, that is not good enough. So if you see the second scenario where on a 1 lakh rupee capital, I'm able to make 1000 rupees. So that will make more sense to me, even though the first strategy had a better reward to risk. But I'll choose the second strategy. Why? Because I also need absolute profit. Because if I just make 100 rupees out of 1 lakh rupees, that is not good enough, right? So the strategy selection process should be where it should be a balance of how much is the reward to risk and how much is the absolute profit that I'll go and make. And if you can, find that, so it is not just that you need to go and find the best reward to risk possible, but a balance between the best reward to risk and the absolute profit. If you can find that, then that will be the strategy where you should be investing. So I hope that this entire concept is clear. Before I jump in and show you some examples, let me just quickly summarize this. Nifty 65 strikes, you have calls and put, buy and sell, 260 ways of trading it. If I go and create a 4-leg strategy, that will be 186 million combinations, and all the way, if I take 3-leg, 2-leg, 1-leg, it comes to approximately 189 million combinations of how you can go and create an option strategy. But one of the answer, if you can solve this, then you have extra money or direct impact on your profit. Why? Because on the same forecasting, instead of making, let's say, a 1:1 strike rate, you are trying to achieve a 2:1 reward per risk. So if you see this example, Nifty futures, if the future had a payoff of 100 rupees and 100 rupees, that's a 1:1. We'll go to options only when we can go and amplify that. And maybe, so there could be two possible ways. I amplify the profit, or I reduce the losses when I'm making losses, or maybe I could achieve both also. That could also be a third scenario, right? So the entire objective will be that we should be able to achieve a better reward to risk. But reward to risk is not the only thing that we would want to achieve, which we saw in this example, that if I take two strategies and if both the strategies have same margin of 1 lakh rupees, then the first strategy had a reward to risk of 4:1 because it's making 100 rupees with a 25 rupees loss. But I'll not go with this strategy. The reason is that 100 rupees profit is not good enough on a 1 lakh capital, right? So if I look at the second scenario, where you have 1,000 rupees profit and 500 rupees losses, even though the reward to risk is slightly lower, it's only 2:1, but I'll still choose this because the quantum or the absolute profit is large enough, right? So you'll have to balance it out. And there's no thumb rule on of how what should be the right balance, because it's a matter of preference of how much risk tolerance you have, and accordingly you can go and decide. But basically, balancing it out is something that we will have to achieve. So let's directly jump in and try something. So how will we solve this? Obviously, this 189 million scenarios cannot be solved, manually. So what will we do is we will go and we'll go basically to the optimizer algorithm that we have, where if I click on find strategy, right? So let me, so I'll explain you all the three possible scenarios. So why three? Because bullish and bearish both are directional. So one of these, and then either way is an oscillating. So I'll explain you all three scenarios of how we can go and achieve this. So let's say first we try with the bullish strategy. So the Nifty future right now is at 18,264. Okay. So what I can do is, let's say if I want to take a trade for tomorrow, which is Wednesday, and just before I get into this, ideally you should be doing this in market hours. Even though we can do it now, there's no problem. But there are some mispricing that can happen in the options premium when we look at things end of the day. I'll tell you how. Let's say you know that there's a 30-minute VWAP that will be taken for the closing prices. So maybe till the last moment, or maybe let's say there was an option which was traded at 329.30, and then there was no trade, even though there was bid and ask, but there was no trade. But the Nifty went down by 20 points, and that did not reflect in that option price, right? So what can happen is that if you look at it end of the day, then there could be a possibility that it will first pick up that arbitrage opportunity, and it will automatically detect that, okay, this option is cheaper. But when you do that in the live market, then that gets taken care of because this analytic will run on bid and ask. So automatically that will get taken care of. And if there is a mispricing in options, or let's say if some option is cheaper, automatically the algorithm will try and pick that up as well, right? So let me directly jump into the forecasting. So what we have done is we have selected Nifty. You can put Nifty, Bank Nifty, or any stocks that you want of your choice in this. We'll automatically see what is the current market price, which is 18,264 right now for Nifty. And now we need to decide, okay, what is the forecast that I have? So as I said, where will the forecast come from? It can come from maybe you are following some technical analysis model, or let's say you are following some derivative model. I've taught a lot of models in the past webinars also. So let's say from there, you have created a forecast, okay, this stock or Nifty is going to go up, okay, or go down, whichever might be the scenario. So we choose our direction, which is bullish for now. And then we need to choose the target date that, okay, what is the time frame when I expect this target, whatever target I'm going to set to come. So let's say I'm setting it to tomorrow, which is 9th November. So I'm trying to see, okay, if my target and stop loss comes by tomorrow, I want to create an intraday trade tomorrow, then what should be the strategy that I should go for? So what I'll do is, let me, for simplicity, let me just add a calculator and show it to you. So it's 18,264. So I'll put 18,364 as the target, which is basically 100 point, right? So I'm putting target as 100 point, and the stop loss, maybe I'll keep it simple for now. So what I can do is I can keep a stop loss also of 100 point. So what I've done is, if you see this, my target, I'm saying till tomorrow, for tomorrow, I want to go and create an option strategy. But my target is 100 points and my stop loss is also 100 points. So if I go and take this trade in futures, it will make no sense, because if there's, let's say, a 50-50 probability of the market going up and down, right, then I don't have an edge in taking this trade. But using options, we'll see if we can go and achieve an edge. So we can go and click on optional parameters also, and I'll explain you in some time what exactly this is, but I'll keep this as it is for now. But the only thing that I want to show to you is that we are trying to find an optimal strategy. There are many options. I can go and find the best reward to risk strategy. I can find the maximum absolute profit strategy or maximum ROI strategy. But the reason we are choosing optimal, just some time back in Excel, I showed you that even if something has a 4:1 reward to risk, still you might choose the 2:1. Why? Because it has more absolute profits, right? So I need a balance between the reward to risk and absolute profit, and that's why we are choosing optimal. So I'll just click on apply. And what has happened in a blink of a second, behind the scene, almost that 189 million combinations the machine was able to run, which is crazy. And that's the power of compute nowadays, right? So the moment we clicked on apply, all those possible scenarios ran on the server, and it told you, okay, this is the answer that you are looking at from those 189 million combinations, right? And it tells me that I can go and create one of these strategy, and we can go and maybe, depending on our preference, we can go and see inside it which one is more lucrative to me, and I can go and create that strategy. But basically, it's showing me, if I just explain you what the summary is, we can go and create a long call, which will have a 2.22 reward to risk, right? So if you look above, we entered a reward to risk of 1:1, right? And this is the biggest motivation of coming into options, not about where the market is headed. The biggest profit that you can make from options is that your forecast was 1:1, but you can create a strategy which is 2.22:1, right? So each time you make money, you make more money, and when you lose less, and that is the entire game of options. So if you see long call, 2.22 is the reward to risk. If your target comes, will make 6,700 rupees profit, and if the stop loss comes, you'll lose 3,014 rupees. Then there's another possibility. You can also go and create a bull call spread. So we'll see which strike and what details we can see it inside it. I'll come to that also, but I'm just showing you what the summary is so that you can decide on which strategy you want to go and evaluate further. So reward to risk is 2.55 in this case. The target profit is 6,800 rupees and the stop loss is 2,600 rupees. But a bull call spread relatively will have slightly more margin than a long call, right? And then you have a bull put spread, a call ratio back spread, a bull call ladder, right? So you have multiple strategies, and you have the absolute profit also mentioned right there, which you can go and see. And then what I'll do is I'll click on the long call, right? So even if my view is bullish, but so let's say before I go and click inside it, if the market was trading at 18,264 And if my view is 18,364 target and 18,164 stop loss, if I talk about a simple call, obviously if I have to play a bullish view, I'll go and buy a call option. Then which strike call option should I go and buy? Out of so many strikes in Nifty, which strike call option will give me the best possible reward to risk? Even that is a complicated thing to do, right? And that's where the algorithm has solved it for us. And if I click on this, it tells me that if I have to achieve the best possible reward to risk, given my target, my stop loss, which is 100 point up, 100 point down. So if you were thinking ATM, you are wrong. If you were thinking OTM, you were wrong. So the best possible strike will be 18,000 call option, which is slightly in the money. And if you go and buy that for the weekly expiry, which is 10th November 2022, right? Then you will have, if your target comes, which is 18,364, you will have a profit of 6,704 rupees. And the reason that you see mean, best IV, worst IV is because that is not the expiry day, right? Tomorrow is not an expiry day. So it is, IV can create some impact to your strategy. It will not be precise and exact, right? So it's showing you that even if the IV moves, in this case, it's very less sensitive. So you can see that if the IV changes, then these are the changes that you can have. But IV is creating a lot of impact on the losses. So if you see the losses, if your stop loss gets triggered, which is 18,164, you lose 3,000 rupees in this strategy. And if the IV goes up, and by default it takes 25%, which you can see skew up is 25%, which means that if the IV is at 10, if it goes up to 12.5, right, then what will happen? Then your losses will reduce to 2694. And if the IV goes down, then your losses will increase to 3,221. And that is what it is trying to show you. So for now, if you're a beginner, if you don't know much about IV, you can just ignore this segment. That's completely fine. But if you're an advanced trader and you know all about what IV is and how IV can create an impact on the option strategy, then you can look at this, or you can change these numbers in the parameters as well, and accordingly go and create a strategy. So if we look at this, what we have achieved so far is that on a forecast which I had on Nifty of 1:1, we are able to amplify that forecast to how much? 2.22:1. And even if I was flipping a coin and telling myself that the market is going to go up, still if I consistently keep doing that, I might still be profitable. Why? Because every time I'm doing that, I'm choosing the best possible strategy. And then on the right panel, I can either look at a graph, a payoff graph, or I can look at a table view as well. That if I take this strategy, if the market goes up, then at what level, how much profit can I make? And at different levels on the downside, what will be the losses that I make, right? And obviously on your target level and your stop loss level, you have the profit and the stop loss, which is mentioned right there. Okay? So if you want, you can go and take this strategy to the architect also, and you can place an order directly by linking your broker as well. So I'll go back and I'll click on the select. So there were more strategies. So I can go and click on select. And then if you see, then there's another possibility that I can go and create a bull call spread. So if I just try and have a look at that as well, then it tells me that I should be creating a bull call spread. Now, which strike bull call spread will be the most profitable? In my scenario, it is going to be buying a 17,950 call option, which is again in the money, and selling an out of the money call option, which is 18,500, because obviously it's not the expiry date. So all the Greeks are still playing out. And this is the best possible combination that you can have. And if you do this, then if you see, it is slightly better than the previous strategy where you have 6,800 rupees profit instead of 6,700. And instead of a 3,000 rupees loss, you have 2,675 roughly as a stop loss. So it's a matter of preference if you like this strategy, or in this case, you don't have a significant difference in the payoff. But in some cases, when you have a significant difference in the payoff, then you can choose which strategy you want to go to. Right? So what we did is we solved, let me just go back to this again. So what we did is we solved for a 1-day view. Now let's say if I want to go and create this a strategy for 10th November with the same view. Let's just try and apply this and see what happens. So if I again a 100-point target, 100-point stop loss, if I want to add one more day, that not till tomorrow, but till day after tomorrow, if I want to go and create a strategy, then what are the possibilities that I can achieve, right? So the first one is again a long call. If you see this, still the reward to risk is 2:1, which is again high because the original forecast was just 1:1, but I can still achieve 2:1. And the strike in this case remains same. 18,000 will be the strike which the algorithm is choosing. If we look at the second scenario, bull call spread has now a reward to risk of even higher, which is 4.22, which is significantly high. If I look at this, now the strikes have changed, right? So what happens is, because I am now choosing the expiry date, which is 10th November, automatically the selection of strike and what will be the payoff at the end of the day is going to change because all the Greeks are playing out. And you don't need to think about those Greeks because the algorithm is already taking care of it. Otherwise, you'll have to go and learn everything on how things are changing inside, the Greeks as well. So if you see this, then now the algorithm is telling me that I should be choosing a 17,950 call option, buy and sell instead of 18,500. Now it is telling you if you want to hold the strategy till 10th November, then you go and sell 18,350 call option. If you do that, then on your target profit, which is target level, which is 18,364, you'll make a profit of 7,500. And if your stop loss hit, you'll only lose 1,783. And I feel that if I have to, if I have this kind of a view, then I think I should be choosing I should be choosing this strategy because the reward to risk is significantly high, 4.2:1. Let's see other possibilities as well. So if you see this, then there are more strategies possible. And there is a ratio called spread, which has a reward to risk of 19:1, which is crazy, right? So if I click this, then it is telling me to do the same thing, 17,950 buy, but it is asking me to sell 2 lots of 18,350 call option. And if I do that, then my reward risk increases to 19:1. But why should we not be doing this? Anybody? Maybe you can write in the chat. Okay, so the reason some people might choose this, some people might not choose this, is that this is the extra selling that we are doing in this strategy. So there are two problems with it. One is that if the market goes up too much, then you will start creating losses. So if I show you the payoff, if the market goes up, I start making money. And then this is the inflection point where my profit again starts dropping down. And eventually, I start making losses if the market goes up too high, right? So for people who don't want to take this sort of a risk, because let's say if the market opens 300-point gap up, then what happens? Then obviously you'll be making losses. So if some people might not want to go and take that sort of a risk, some people might want to go and take that sort of a risk. So it depends on individual preferences of how much risk you want to take. And then the second thing that you will have is that because you are selling an extra option, your margin requirement is going to shoot up, right? Because you are selling naked call options extra, right? So you'll have to pay a lot more margin. But for people who are ready to take that sort of a risk, can go and do a ratio call as well. And if you do this, then obviously the reward to risk is crazy. It is 19:1, which is significant. But you should be aware that you can have scenarios where you might end up at a unlimited loss strategy as well. And similarly, bull call ladder, this also does this a very similar thing. It sells an extra leg. So if you see this, it's saying that one more choice is that you can buy 17,950, sell 18,350 one lot, and sell one more lot of 18,400, right? By doing that, your reward to risk is still high, 9.3:1 roughly. But again, the same thing, you're selling one more extra lot of call option And if you're doing that, then obviously your margin will also go up. Plus, you have a unlimited risk profile, right? So if I don't want unlimited loss strategies, what I can also do in optional parameter is I can click limited risk only. If you, let's say, if you're not aware and if you're new to trading options, then you can just select this limited risk only and click on apply. The moment you do that, if you see now, none of the strategy has a unlimited risk profile, right? So still you have a modified call butterfly that you can do, but this strategy will make money only when your precise target comes, right? Which you can go and check in the payoff as well, that where is the strategy making money. And if you are comfortable with this payoff, which is again a preference, then you can go and execute this as well. So the entire idea is that instead of having, even though I had a original forecast of how much 1:1, right? So if you see this, it is 100 point up, 100 point down. But by using this algorithm or by using the entire concept of choosing the right strategy, I can add significant amount of profit. And let me tell you from my own experience, this profit is going to be larger than the forecasting profit that you can do, right? Because this is almost certain that you're choosing the right strategy and it is most probably going to behave in the same way. But the forecast can go wrong, but the math will not go wrong, right? So what happens is that if we choose the right strategy, eventually over the number of strategies, let's say if you do 10, 12, 15 strategies, you'll start seeing that difference that your profits are increasing more and your losses are reducing by just spending time and choosing the right strategy. And this algorithm basically helps you solve that complicated problem for you, where it is going ahead and solving not standard formula. So, I see a lot of people who take very static strategies and try to just go and deploy it. Let's say if you're doing a bull call spread, it will take ATM and sell 2 strikes up. So this algorithm is not a static one where it is just using, rule-based price. Behind the scene, what is happening is it is actually going and evaluating all the possible scenarios of 189 million combinations, and it is telling you that, okay, this is the best strategy which you can go and execute out of everything. But still some, Greeks will keep moving and things will not be precise, right? This will not be exact rupee to rupee, but it's the best approximation of what will happen with the given scenario. So let me quickly cover 2 more things. Which is, one of the beauty of options trading is that you can also say that the market is either going to go up or either it is going to go down, right? But it is going to move somewhere. Even that is the view, and you can go and take a trade on that as well. So let's say for 9th November, if I say that maybe there is some news or something happened and you have a view that, okay, the market is going to move. Okay, movement means what? Let's say if you say that the market can go up either 18,400, or if this news or something does not come, then maybe the market can go down to 18,100. Let's say this is my view. What I can do is I can also go and find a strategy. I did something wrong. So target down is first. So 18,100 and 18,400. I entered it the other way around. So if let's say this is my view, then I can go and create an option strategy on that as well. But if you see, this view is not good enough because the movement that I'm expecting, the market is already discounting maybe a similar kind of a movement, and that's why the reward for it is not good enough. So only if, let's say if I have a view of 18,000 and 18,500, let's see if this makes sense. Okay. So if you see, if I chose 18,100 and 400, because I'm saying either way, the market can go anywhere. And in general, the option pricing will account for the market can go anywhere. So that was not a good enough move for you to go and make profit. So only if you have a view that, either tomorrow it is going to go to 18,000 or 18,500, then it starts making sense because your forecast is greater than the market's forecast, right? The range of volatility that you're forecasting is larger than the market's range of volatility. And then it says that you can do a strategy which is called strap, right? And if you're doing a strap, then what will be the, the leg that you'll choose? You'll be choosing a 2 2 lots you'll buy 18,250 call option, and 1 lot you will buy 18,250 put option. So that's a slightly complicated strategy, because in general you would not want to go and you will not be able to think of doing it something like this. But that's the beauty of machines, that it can still solve a call put combination for you and tell you that, okay, if you do this, then you can have the reward price going up for you. And if I do something like this, then I have a reward price of 2:1. And if you see this, if the market remains in this range, which is basically the market's forecasted range, that this is where the volatility is going to be. Now, since your forecast is beyond the market's volatility, so if it moves beyond that range, then you can see that this will be the kind of profit at different levels that you can make. And obviously, if nothing happens, then these are the losses, and this is the loss range where you will create a loss for yourself. So on an average, if your target of 18,000 comes, then you don't have a big profit. That's only 1,300 rupees profit. But if your target of 18,500 comes, then you have 13,800. If this is not a lucrative strategy, then maybe you can check the second one, which is a triangle, which is saying that you can buy a put of 18,150 and a call of 18,200. If I do that, then these are the kind of payoffs that I can have, right? And this is how you can go and just scroll through all of these strategies and find the best one for yourself. I'll also show you that if you want to do a just a specific strategy, you can also go and optimize that as well, which I'll show you in some time. So before that, let's quickly see the oscillating view as well. So oscillating basically means that I'm saying that the market is not going to move anywhere, and it is going to remain in a range, right? And generally, these kind of views will create for slightly medium term, right? So I'm saying till 18 November, or maybe I'll not choose the expiry date. Okay, it's not the expiry date. So 18 November, and I say that the market is going to have a lower range of 18,000 and upper range of 18,500. And I want to keep a stop loss. I'll say that if it reaches 17,900, it means that it is entering a downward direction. So that's my stop loss on the downside. And on the upside, my stop loss is 18,600, beyond which, if the market goes, then I'll say that the market is now headed upward. So if I do a get strategy, then it tells me that a modified long condor is what you can do, and you will have a reward price of 2.86, right? So because it's a hedge strategy, so you'll see that the returns that you'll make is slightly lower. But the good thing is that you'll pay less margin in doing this, so you can take more number of lots for doing the same thing. And these are the legs that you'll have to execute: buy a call of 18,000, sell a call of 18,200, then sell a call of 18,300, and buy a call of 18,500. So these type of combinations are, manually is very difficult to even think of. Which strike, which one, should I go for, which will give me the best possible profit. And this algorithm is basically telling you that, okay, these are the strikes that you need to participate, and the reward risk is going to be 2.86, which you can specifically see at each level what is the profit loss that you will go and do. So one last thing before we call it off is, let's say if I want to do specifically a bull call spread, okay, and I want to only find which are the best possible bull call spread that I can go and execute. So I can go also to the second option, which is find specific. And if I click on that, then I can choose that, okay, I want to do a bull call spread. So I'll click on this, okay. And I'm saying that my target date is, let's say, 10th November, or it could be any day. So maybe I'll say 9th November, which is pre-expiry. And my target is, let's say, 18,400 and stop loss is 18,150. So this is my revised target. I can also go an optional parameter and choose what is the strike range that I want the algorithm to use, right? So I can say, choose on the lower side, don't go below 18,000 strike. On the upside, don't go above 18,600 strike. And if I do this and I click on apply, what will happen is that it is now telling me the combinations of a bull call spread, right? So it's telling me that the best possible reward to risk and absolute profit combined, right? So as we learned in the beginning, reward to risk and absolute profit combination, the best possible way will be doing obviously 18,000 and 18,600. If I do this, then this is the profile that I'll have. Or the second choice is that I can do a 18,000 call, 18,550 call, which will have a 2.43 risk to reward. And if you see this, I think this is the best reward to risk. If you want to go for reward to risk only, then 18,000 call and 18,450 call option. Right. So if you want to, let's say, sometimes what can happen is in the original algorithm, you might have a odd strike. Okay. And you want to find which are the second best possibilities within the bull call spread family. So you can then specifically select a bull call spread and you can create an optimization inside that as well. Right. And if I do that, then I can go and find only the bull call spread combinations. Now, just going back to the optimizer again, I just want to quickly explain what are the optional parameters. So by default, this algorithm is taking a lot of boundary conditions, which we call in mathematics. So it's taking a risk to capital ratio of 50-50, right? So you can change this, which basically means that it will never take a risk of more than 50% of the margin that will be required for that strategy. If you want to change this for some conservative trader, you want to keep it 20%, that is fine. You can keep it 10, right? So you can change these numbers according to your preference. Then you can change the strikes as we just saw. So by default, right now, RP industry is selected. So let's say if it had been Nifty, you can change the strikes and you can give it a tight range also if you want. That choose the strategy only from this strike to this strike. That is possible. Then you have maximum number of legs. So if you don't want a 4-leg strategy and only a 1-leg, 2-leg strategy, you can choose that as well. And then this doesn't matter a lot how many outputs you want. So by default, it is 5. You can select this limited risk only, which I already explained. There's one more option of capital and risk. So I can specifically define that I have, let's say, 2 lakh rupees, and I don't want to take a risk of more than 20,000 rupees, right? So I can do this as well. And then whatever strategy comes, it will take care of the margin is approximately around that. Obviously, all the brokers will have slightly different margin. And then the risk that it will take in that strategy will not exceed 20,000 rupees. So this gives you more control on how much money you want to take as a risk for your strategy. And then keeping that risk, it will try to maximize the profitability. Right? So these are the possibilities where you can go and tweak the algorithm for yourself. And then we have something called as skew down and skew up. So for all those advanced option traders who knows how volatility creates an impact, by default, this is 25%. So let's say if you say that the worst case could be 30% up down, so you can put 30%. So basically, if the IV right now is at 10, it will take a range of 7 to 13. Between that, it will try and evaluate your strategy. That even if it goes to 13 and goes to 7, your strategy should kind of protect this risk of 20,000 rupees, right? So even IV impact can be taken care of by this algorithm. So I think that's all from my side. I'll just summarize it so that you understand why it is important to choose the right strategy. And honestly, I feel that this is the most important thing as an option trader that you should be thinking. So first of all, if you are trading futures, then forecasting is very important. But when you are trading options, you can use a bad forecast also. A bad forecast means that even if you have a strike rate of 50%, 55%, that is also good enough. But every time you have to choose the best possible reward to risk strategy on that. And even if you have a good forecasting and you do this as well, then you immediately amplify your profit. So we saw a scenario where we had a 1:1 reward to risk forecast. And on that, we could easily create 2:1 strategy, right? Most of the time. And sometimes it was 4:1, 5:1 also. So, but with the same forecast, you can amplify your profitability and reduce your losses. And honestly, that is where you make money from, right? Not from forecasting. All the mature traders in the market who have been trading for a number of years, they make money from the right strategy selection instead of creating a forecast, right? So I hope that this helps. And if you have any specific topic that you would want me to cover in the next webinar, you can put in the chat box of whichever stream you are in. And I would request you to obviously like the video. If you liked it, then just give a thumbs up and subscribe the channel so that next time we are doing any webinar, you'll be able to get a notification of that as well. So now any questions that you have, you can post it in the chat box of whichever platform you are in, and my team will kind of consolidate it and I'll try to answer a few of them. So let's see, there are some questions that I have. How do you compare reward to risk versus capability to correct the trade later? Okay, so that's a very good question that, whatever initial forecast we entered is not going to be 100% accurate. So if I said that my forecast is that by 10th November, the market will go to this level, obviously it is not going to happen exactly in the same way. Either it takes more time or it does not go to the same level. So then you will obviously need to know some strategy modification techniques, or maybe you can just stay with the same strategy and wait for your time. If your time is for the strategy is done, then you can just square it off. Or maybe you can go and put that strategy in architect and see how, if it is going to take one more day, what is the behavior of the strategy, and if you are comfortable, you can go and choose that. But honestly, any strategy that you take is kind of repairable most of the times, right? So I don't think you should be worried about repairing the strategy at the beginning itself. You can just go and take that strategy, and later on, depending on as the market gives you input, that this is what has happened, then you can re-optimize your strategy continuously to see whether that same strategy is making sense. If not, then you can square up and take a new strategy on the new forecast. Then the second question is how to identify the requirement of capital for a strategy. So I showed you already, there was a margin field which shows you the span margin. So it does not show you the full margin because broker to broker the margin will differ, but it shows you what will be the span margin that you'll have to pay for that strategy. And if your broker is charging you additional 5% on the exposure or whatever, you can just approximately apply that, and that will give you a ballpark number of how much should be the margin. So does this show the exact target and stop loss in terms of premium value of each leg? So the profit loss that you saw was based on, so it's the absolute profit loss. So if I, let's say, would have choose the capital and a risk profile, which I showed you in optional parameters, say if I put 10 lakh rupees capital and 1 lakh rupees risk, then automatically it will tell you how many number of lots you should go and execute, right? So it might be, let's say, 20 lots. So it will optimize that. It will take care of that your risk does not go below beyond 1 lakh rupees. And then it will tell you, okay, maybe you do 15 lots or whatever that number is, that the algorithm will optimize the number of lots also that you can go and execute on that strategy. So I take one last question. Can we have target price and stop loss when our future target and stop loss come? So yes, so that's a good question. If you take this strategy, so I think the question is all about that when your target price comes or stop loss comes, can you get an alert of it? So in Quantsapp, you have an alert module where you can go and set an alert on the target price as well, on the stop loss as well. Or if you want to set a target for the strategy, let's say this strategy makes 10,000 rupees, let me know. You can do that also. Or this strategy loses 5,000 rupees, let me know. You can do that also, right? So you might want to go and look at the alert module, and then all the modules have a how to use video on the top. So if you click on that, you'll be able to see how to use that alert module, and obviously you can achieve an alert that the system will send you the moment your target and stop loss come in terms of strategy PNL or in terms of level. You can set both of it for you. And some advanced traders can also use Greeks as an alert. That is also possible. So you can use any of the Greeks, and that can also be set as an alert. So we'll keep it till there, and thank you very much. And if you like this video, then do write some comments about it, and let us know what should be the next topic that you want to learn from me. And I wish you a good day, and I hope that today's session adds some value to your trading journey. Thank you.